The markets just got rattled. Stocks erased more than $1 trillion in value within hours. The Dow plunged hundreds of points after the Federal Reserve meeting. Bitcoin pulled back. Crypto traders started debating whether this was the beginning of a bigger correction. But while prices were falling, something else was happening behind the scenes. Long-term Bitcoin holders reached a new all-time high. Ripple's RLUSD stablecoin continued expanding across the XRP Ledger. Major financial institutions kept building blockchain infrastructure, and lawmakers in Washington signaled that crypto legislation could move much faster than many expected. So the question isn't whether markets are nervous. The question is whether investors are paying attention to what's still being built underneath all the volatility. Nothing in this video is financial advice. Always do your own research before making investment decisions. Welcome back to Ledger Pulse, your source for the biggest developments in crypto, blockchain regulation, and the future of digital finance. Today, we're breaking down why markets reacted negatively to the latest Federal Reserve decision, what Bitcoin's strongest holders are doing right now, why Ripple's RLUSD growth continues accelerating, major regulatory developments in both the United States and Europe, and why some of the biggest names in finance remain extremely optimistic about Bitcoin's long-term future. Let's dive in. The biggest story of the day came from the Federal Reserve. The Fed decided to leave interest rates unchanged, which wasn't particularly surprising. Markets were largely expecting that outcome. What caught investors' attention was the broader message surrounding inflation, economic growth, and the path forward for rates. Following the announcement, stocks sold off aggressively. Reports showed the Dow dropping roughly 800 points after the decision, while the S&P 500 erased more than $1 trillion in market value in a matter of hours. Whenever markets experience a move like this, it's important to understand what's actually happening. Investors constantly try to predict future interest rates because rates affect nearly everything. They influence mortgages, they influence business loans, they influence corporate earnings, and they influence how much risk investors are willing to take. When borrowing costs remain elevated, investors often become more cautious. That's why technology stocks, growth companies, and crypto assets frequently react strongly to Federal Reserve decisions. The market isn't simply reacting to today's rate. It's reacting to what investors think rates could look like months from now. And right now, uncertainty remains elevated. But there's another side to this story. Short-term market reactions don't always reflect long-term trends. In fact, some of the most important crypto data points continue moving in the opposite direction. While traders focus on every market swing, long-term Bitcoin holders are sending a very different message. New data shows that approximately 79% of Bitcoin supply is now held by long-term holders. That's an all-time high. At the same time, older Bitcoin moving on-chain has fallen to some of the lowest levels seen in years. What does that actually mean? Imagine a neighborhood where nearly every homeowner decides not to sell their house. The number of available homes shrinks dramatically. Even if demand stays the same, a limited supply can create upward pressure over time. That's essentially what's happening with Bitcoin. A growing percentage of owners appear unwilling to sell despite price fluctuations. Historically, periods where long-term holder ownership reaches extremely high levels have often occurred before major market expansions. That doesn't guarantee future price appreciation, but it does indicate conviction. Many investors who have held Bitcoin through multiple market cycles continue holding today. And when supply becomes increasingly scarce, future demand has a greater impact. This is one reason many institutional investors remain interested in Bitcoin despite periodic corrections. They understand that supply dynamics matter, and Bitcoin supply remains one of the most unique assets in global finance. Speaking of institutions, one of the largest asset managers in the world continues expressing confidence in Bitcoin. BlackRock's global fixed income CIO, Rick Ryder, recently stated that he believes Bitcoin will go considerably higher over the long term. That statement matters because it reflects how large financial institutions increasingly view digital assets. A decade ago, Bitcoin was largely discussed as a speculative experiment. Today, it's being analyzed by pension funds, wealth managers, insurance companies, hedge funds, and multinational corporations. The conversation has changed. Many institutions now view Bitcoin through a lens similar to digital scarcity. There will only ever be 21 million Bitcoin. No central authority can create more. No government can vote to increase the supply. Those characteristics are becoming increasingly attractive in a world where debt levels continue growing globally. Institutional adoption doesn't happen overnight. It's usually a gradual process. But each year, Bitcoin becomes easier for large organizations to access, custody, and integrate into investment portfolios, and that's helping drive a major shift in perception. One of the most interesting developments in the XRP ecosystem continues to be RLUSD. According to recent reports, the XRP Ledger stablecoin market has approached the $1 billion mark. Much of that growth is being driven by RLUSD. For anyone unfamiliar with stablecoins, think of them as digital dollars. One token is generally designed to maintain a value 1-to-1 to the US dollar. They allow money to move across blockchain networks quickly while avoiding the volatility associated with cryptocurrencies like Bitcoin or XRP. RLUSD's growth matters because stablecoins often become foundational infrastructure. They're used for payments, they're used for trading, settlement, and increasingly they're being explored by financial institutions. Recent data shows RLUSD has continued expanding rapidly over the past month. That growth indicates increasing usage across the XRP Ledger ecosystem. What's important to understand is that infrastructure growth frequently happens before broader adoption becomes obvious. Most people don't notice payment rails being built. Most people don't notice settlement systems being upgraded. But eventually, they notice the services that run on top of them. And that's what makes stablecoin adoption worth watching. One of the more interesting XRP discussions this week came from market analyst Blockchain Backer. Recent data shows that approximately $40.5 billion worth of XRP is currently being held at a loss. At first glance, that sounds like a massive amount, and it is, but Blockchain Backer's observation wasn't focused on the size of that number alone. Instead, he compared today's market conditions to what happened during previous major XRP bear market bottoms. According to his analysis, the amount of XRP currently being held at a loss remains below the level seen during prior cycle lows. In fact, he noted that XRP held at a loss would need to hit approximately $43 billion, a level that closely aligns with the conditions seen during previous bear market bottoms. Now, it doesn't mean that a major decline is around the corner. What it does mean is that this particular metric is not showing the same degree of capitulation that historically accompanied the deepest points of past bear markets. Think about what typically happens near a major market bottom. Many investors have already sold. Confidence is extremely low, negative headlines dominate the conversation, and a large percentage of holders are underwater. Those conditions often create the kind of widespread pessimism that marks the final stages of a bear market cycle. What Blockchain Backer is highlighting is that today's data doesn't yet resemble those historical extremes. In other words, despite the volatility we've experienced, the metrics suggest the market hasn't endured the same level of pain that characterized previous cycle lows. That doesn't tell us where XRP goes next. Markets don't repeat perfectly, and every cycle unfolds differently, but it does provide useful context for understanding where we are today relative to the past. Looking at investor positioning often reveals things that price charts alone cannot. And according to this particular metric, XRP currently appears to be in a very different position than it was during the depths of previous bear markets. The broader takeaway is simple. Price tells part of the story. Market structure, investor behavior, and historical comparisons help tell the rest. Whether you're looking at Bitcoin holders refusing to sell, XRP market positioning, or stablecoin adoption growing across blockchain networks, a common theme keeps appearing. The infrastructure side of the industry continues advancing regardless of short-term price swings. The infrastructure side of the industry continues advancing regardless of short-term price swings. And one of the clearest examples of that trend comes from a major development involving Moody's. Moody's has expanded its token integration engine onto Solana. The significance goes far beyond Solana itself. Credit ratings are among the most important pieces of information in traditional finance. They help investors evaluate risk. Historically, these ratings existed primarily inside databases and documents. Now they're beginning to become machine-readable and integrated directly onto blockchain infrastructure. Think about what that means. Financial information can become more transparent. Systems can become more automated. Data can become easier to access and verify. This is part of a broader trend where traditional finance and blockchain technology are gradually converging. Instead of replacing existing systems overnight, blockchain is increasingly being integrated into them. And that's a much more realistic path toward widespread adoption. While much of the attention remains focused on the United States, Europe continues moving forward as well. BitGo Europe recently launched a MiCA-ready crypto-as-a-service platform ahead of the European Union's licensing deadlines. Regulation often sounds boring, but it's one of the most important pieces of the adoption puzzle. Large institutions generally don't deploy significant capital into industries lacking regulatory clarity. They want clear rules. They want compliance frameworks. They want legal certainty. The MiCA framework represents one of the most comprehensive crypto regulatory structures developed anywhere in the world. Whether people agree with every aspect of it or not, it provides something businesses value greatly: predictability. And predictability often encourages investment. Speaking of regulation, momentum appears to be building in Washington. Recent comments from lawmakers suggest efforts surrounding the Clarity Act could move more quickly than many expected. For years, one of the biggest challenges facing the U.S. crypto industry has been uncertainty. Companies often struggle to determine which rules applied to different digital assets. Investors face confusion, developers face uncertainty, businesses face legal ambiguity. The purpose of legislation like the Clarity Act is to establish clear definitions and responsibilities. Whether the final version satisfies everyone remains to be seen, but the broader trend is difficult to ignore. Lawmakers are spending far more time discussing digital assets today than they were just a few years ago. That alone represents a significant shift. The conversation has evolved from whether crypto should exist to how it should be regulated. When you take a step back and look at everything together, a fascinating picture begins to emerge. Markets are nervous. Stocks are reacting to Federal Reserve policy. Traders are watching every move in Bitcoin and crypto prices. Yet simultaneously, long-term Bitcoin holders continue accumulating. Institutional leaders remain optimistic. Stablecoin adoption continues growing. Blockchain infrastructure continues expanding. Regulatory frameworks continue developing. And financial institutions continue integrating blockchain technology. Those developments rarely make headlines during volatile market days. Price action captures attention. Infrastructure rarely does. But infrastructure is often what shapes the future. The internet wasn't built in a day, neither was modern banking, and digital asset infrastructure is following a similar path, slowly, quietly, and often without attracting much attention until years later. So what do you think? Is the market overreacting to short-term uncertainty, or do you believe more volatility is ahead before crypto's next major move? Drop your thoughts in the comments below. If you enjoyed this breakdown, make sure to like the video, subscribe, and turn on notifications so you don't miss future updates. And if you want to understand what's happening beneath the surface of the crypto markets, not just daily price swings, check out one of the videos on your screen right now. Thanks for watching, and we'll see you in the next one.